All right, let's just jump right in. Every single one of us who trades, every one of us, eventually hits a wall. You realize that hunting for the next perfect entry just isn't the answer. And that's where the real work, the real progress, begins. Today we're going to flip the script. We're shifting our focus away from finding winners and onto the one thing that truly separates the pros from everyone else, mastering your risk. So let me ask you something, and be honest with yourself. Why do so many traders fail? Really fail. We've all seen those stories, right? The person who turns a tiny account into a fortune, and we think, hey, that could be me. But the reality for most is, well, it's a painful wake-up call. What's the one thing that consistently blows up trading accounts?
And here it is. This is the big secret, and it's a total mindset shift. It's not about having some magical crystal ball or a system that's never wrong. The real secret is being absolutely obsessed with controlling the downside. It's all about how you handle the trades that go against you, not just popping the champagne for the ones that go your way.
And that leads us right to it. The single biggest mistake, the one thing that torpedoes most trading careers before they even get started. This is the core problem we're going to unpack and solve right now.
Listen to this quote from the legend George Soros. He just nails it. This is the entire game in one sentence. Think about it. You can be wrong half the time, you can even be wrong more than half the time, and still be incredibly profitable. How is that even possible? Simple. You just make sure your winning trades are a whole lot bigger than your losing trades.
Okay, so how do we actually do that? How do we build that lopsided advantage in our favor? Well, it all comes down to mastering one simple but incredibly powerful tool. This is the engine of profitability.
It all boils down to something called the reward-to-risk ratio. You'll hear it called RRR, and it's dead simple, really. Before you even get close to that buy or sell button, you have to ask yourself two questions. What's my potential upside, and what's my potential downside? The ratio between those two numbers, that's everything. Seriously, without it, you're not trading, you're just rolling the dice.
And this is where it gets really powerful. Just look at this graph. If you're going for a one-to-one trade, risk a dollar to make a dollar, you've got to be right more than 50% of the time just to stay afloat. But check this out. If you aim for a 3-to-1 ratio, suddenly you can be wrong 3 out of 4 times and still come out ahead. It totally takes the pressure off of needing to be perfect.
This all ties into a concept called expectancy. It's basically the cold, hard math that tells you if your trading system is actually going to make money over time. Take a look at System 1 here. Winning 60% of the time with a 1.5 RRR, that's a winner. It's got a positive expectancy. But now look at System 2. Yeah, a 50% win rate feels okay, right? It feels like you're breaking even. But with that RRR below 1, you're on a sinking ship. That negative expectancy is like a slow leak that is guaranteed to sink your account.
Okay, so you get it. Set a good RR before the trade. Easy enough. But this right here is where the amateurs stop and the pros begin. See, risk isn't a static number. It's not a set it and forget it kind of deal. It's alive. It changes with every single tick of the price.
So let's walk through a trade. Nice and simple. We buy a stock at $100, we're aiming to sell it at $120, and our get-me-out safety net, our stop, is at $90. We're risking $10 to potentially make $20. That's a solid 2-to-1 RRR. On paper, it's a beautiful trade.
But then the price starts moving our way. It hits 110. We're feeling good, right? We're in the money. But hold on a second. Stop and think. What is our risk right now? Our stop is still way down at 90. So from 110, we are now risking a $20 drop. All for what? To make just $10 more to hit our target. Do you see what just happened? Our beautiful 2-to-1 ratio has flipped completely upside down into a terrible 1-to-2.
And it works the other way too. What if the price drops against us to 95? If you do the math, your RR looks amazing. It's like 5-to-1. But, and this is a huge but, the whole reason you got into the trade is now in question. The price has to climb way, way higher just to get back to even, let alone your target. The probability of the trade working out has just plummeted. So what's the pro move here? It's active management. Let's rewind. When the price hit 110, instead of just sitting there hoping, what if we moved our stop loss up to 100, right to our break-even point? Boom. Just like that, we can't lose money on the trade. We're now risking $10 of profit to make another 10. Our RRR is back to a much healthier 1-to-1. See? We're managing the risk as it changes, not just crossing our fingers.
So let's break down what this really means, because this is huge. First, that profit that's just sitting there on the screen, it's yours. Stop gambling with it. Second, forget that old saying, you can't go broke taking profits. Oh yes, you can. If you always take tiny profits, you'll never pay for your inevitable losers. Third, sometimes you gotta cut a loser early. If the reason for the trade is gone, get out. Don't wait for the stop. And last, I cannot say this enough, do not let a winning trade turn into a losing trade. Protect your capital.
Now, this all sounds good in theory, right? But let's look at a real-world example, maybe the most famous trading experiment of all time. I'm talking, of course, about the legendary turtle traders.
If you don't know the story, it's incredible. They took a bunch of regular people, a blackjack player, a security guard, an accountant, with zero trading experience, taught them a system, and turned them into millionaires. And you want to know their secret? It wasn't some mystical entry signal. Their entries were dead simple. The real magic, their entire edge, was in their hyper-strict rules for managing risk.
One of their biggest secrets was adapting to the market's mood. Look at these two charts. On the left, you've got a quiet, calm market. Their stop loss would be super tight. Now look at the one on the right. The market's going nuts, big wild swings. Their stop would be way wider, giving the trade room to breathe. But here's the genius part. The amount of money they were risking on each trade was always the same. Say 2% of their account. They'd just trade a much smaller position in the volatile market to keep that dollar risk constant. It's brilliant.
And that was just one piece of their system. Their whole process was a fortress. First, they'd use volatility to set the stop. Then, they'd calculate the exact position size to risk their fixed 2%. They'd even check to make sure they weren't accidentally buying 5 different things that all moved together. And get this, they would add to their winning trades to maximize them. But if they hit a losing streak, they'd cut their size way back to protect their chips. It was a complete defensive system built for survival.
So you see all these pieces, the RRR, managing risk on the fly, the turtle rules, they're all pointing to the exact same truth. Trading isn't about getting rich quick. It's a marathon. It's all about winning the long game.
And what powers that long game? A little thing that Einstein supposedly called the 8th wonder of the world, compounding. Because when you stop blowing up your account and just consistently apply a system with a positive edge, over time, something truly magical starts to happen.
I want you to really look at this chart. This is what compounding looks like. And see that first part, the long, flat, kind of boring section? That's the danger zone. That's where almost everyone gets frustrated, thinks this isn't working, and quits, usually right before the curve goes vertical.
Think about this number for a second. 90%. For most traders who actually make it, a full 90% of their journey is spent in that boring phase. It's just grinding, sticking to the plan, and feeling like you're not getting anywhere. But that 90%, that's the price you pay to experience the explosive 10% at the end.
So it all boils down to developing a professional mindset, and it really has 3 parts. 1, you have to accept randomness. Winning streaks and losing streaks are just part of the game. They don't define you. 2, you have to be ruthlessly consistent. Your risk rules are not guidelines. They are law. They are non-negotiable. And 3, you got to be patient. You have to have the mental toughness to grind through that long, flat part of the curve.
So I'm going to leave you with one final question, and I want you to be really honest with yourself. Are you acting like a professional risk manager, meticulously controlling your downside and playing the long game? Or are you just chasing the thrill of the next entry, gambling on the outcome? Because how you answer that question, well, that's going to define everything.